Nilkant then turned his attention to silver and said, "Silver is often referred to as the poor man's gold because it provides many of the benefits of precious metals while being more affordable and accessible to a wider range of investors." After examining the long-term silver chart, Nilkant pointed out an important difference between gold and silver. Unlike gold, he explained, the returns from silver tend to be concentrated within relatively short periods of time. Silver often spends many years moving sideways or generating modest returns, followed by brief but powerful rallies. As a result, timing becomes more important in silver than in gold.
Nand looked more closely at the chart. Nilkant continued, "Another interesting observation is that gold prices in Indian rupees have historically exhibited a strong long-term upward trend due to a combination of international gold prices and the gradual depreciation of the rupee. Silver, however, behaves somewhat differently. While Indian silver prices are influenced by currency movements, they tend to resemble the international silver chart much more closely than gold does. In other words, silver does not benefit from rupee depreciation to the same extent that gold appears to over long periods." He pointed toward another section of the chart and said, "Silver also has a significant industrial component. It is widely used in electronics, solar panels, batteries, medical equipment, and various manufacturing processes. Because of this industrial demand, silver often responds more strongly to changes in the economic cycle than gold." Nilkant then showed Nand the silver chart in Indian rupees. Nilkant added, "Historically, some of the strongest moves in silver have occurred immediately after economic recessions, when economic activity begins to recover and industrial demand starts rising again. During these early stages of recovery, silver has often outperformed gold because investors anticipate increasing industrial consumption." Not necessarily. Silver can be more volatile and may experience larger price swings than gold. However, during the initial phase of an economic recovery, silver may benefit more from improving industrial demand. As the recovery becomes more established and investors shift their focus toward wealth preservation and stability, gold often regains its attractiveness as a store of value. He concluded, "The key lesson is that gold and silver serve different purposes. Gold is primarily a store of value and a hedge against inflation and uncertainty. Silver, on the other hand, combines the characteristics of a precious metal with those of an industrial commodity. Understanding where the economy stands in its cycle can help investors decide how to balance their exposure between the two metals." Nand looked thoughtfully at the charts displayed on Nilkant's laptop and asked, "Nilkant, we have discussed how gold and silver behave differently during various phases of the economic cycle. Is there any indicator that can help investors decide whether they should hold more gold or more silver?" Nilkant smiled and replied, "Yes, Nand. One of the most widely followed indicators is the gold-to-silver ratio." "The gold-to-silver ratio?" Nand asked curiously. "Yes," said Nilkant. "The ratio simply tells us how many ounces of silver are required to buy 1 ounce of gold. Historically, this ratio has averaged around 60. In other words, 1 ounce of gold has generally been worth about 60 ounces of silver." Nand leaned forward with interest. "How can investors use this ratio?" Nilkant picked up a pen and drew a few numbers on a notepad. "Think of it as a relative valuation tool," he explained. "When the gold-to-silver ratio rises above 80, it often suggests that silver has become relatively inexpensive compared to gold. In such situations, investors may consider gradually accumulating more silver than gold. On the other hand, when the ratio falls toward 50 or below, silver may have become relatively expensive, and it may make sense to shift a larger portion of holdings toward gold." That sounds simple enough. So whenever the ratio goes above 80, we should buy silver? Nilkant laughed softly. That is where many investors make a mistake. The gold-to-silver ratio is a useful indicator, but it is not a magic formula. "What do you mean?" asked Nand. "The ratio must always be interpreted within the broader economic context," Nilkant replied. "Let me give you a recent example." He opened another chart and pointed toward the period after September 2022. During this period, the gold-to-silver ratio climbed above 80. According to historical averages, silver appeared relatively undervalued. Investors who accumulated silver during that phase benefited because silver subsequently performed well and the ratio gradually moved lower.
Nund nodded. So the strategy worked?
Yes, it did, said Nilkant.
But markets are never that straightforward. After September 2024, concerns about economic slowdown, recession risks, and trade war uncertainties began to dominate investor sentiment. Nund looked puzzled. What happened then? Even though the gold-to-silver ratio remained above 80, gold significantly outperformed silver. Normally, such a high ratio would still suggest accumulating silver. However, investors were no longer focused on industrial growth and economic recovery. Instead, they were seeking safety, stability, and wealth preservation. As a result, money flowed into gold rather than silver.
So the ratio alone was not enough, Nand observed. Exactly, replied Nilkant. Silver benefits when investors expect stronger industrial activity and economic growth. Gold, on the other hand, tends to perform better when investors are worried about uncertainty, recession, financial stress, or geopolitical tensions. Nand smiled. Now I understand. The gold-to-silver ratio tells us what may be relatively cheap or expensive, but it does not tell us why investors are buying one metal over the other. Well said, Nilkant replied. That is the key lesson. The gold-to-silver ratio is a valuable tool, but it is not a holy grail. Investors should combine it with an understanding of the economic cycle, inflation trends, recession risks, investor sentiment, and geopolitical developments.
He closed the notebook and concluded, "The most successful investors never rely on a single indicator. They use multiple pieces of information to understand the bigger picture. The gold-to-silver ratio can point us in the right direction, but understanding the economic environment helps us decide whether to follow that signal or not." Nand nodded thoughtfully. "So the ratio provides the map, but understanding the economic cycle tells us which road is actually open?" Nilkant smiled. "Precisely, Nand. And that distinction often makes the difference between an average investor and a successful one."
Nilkant, we have spoken a lot about why silver can be an important part of an investment portfolio. But how can an investor actually invest in silver? That's a very practical question, Nand. Today, investors have three popular ways to gain exposure to silver: physical silver, silver ETFs, and silver mutual funds. Each option has its own advantages and limitations. Let's start with physical silver. That sounds the simplest. Indeed, physical silver means buying silver bars, coins, or jewelry and holding the metal directly. What are the advantages? The biggest advantage is ownership. You possess the actual metal, and there is no dependence on any financial institution. Many investors also like the psychological comfort of holding a tangible asset. That sounds appealing. Are there any drawbacks? Yes. Physical silver requires safe storage, insurance, and protection against theft. In addition, investors often pay making charges, GST, and dealer margins, which can reduce returns. Nand nodded thoughtfully. Nand, what about silver ETFs? Nilkant, a silver ETF, or exchange-traded fund, is a fund that holds physical silver and trades on the stock exchange just like a share. So I can buy and sell it through my trading account? Exactly. Silver ETFs provide exposure to silver prices without the inconvenience of storing the metal. They are highly liquid and generally track the market price of silver quite closely. That sounds more convenient than storing bars and coins. For many investors, it is. However, you need a demat and trading account, and the ETF charges a small expense ratio for managing the fund.
Nand took a sip of coffee. Nand, and what about silver mutual funds? Nilkant, silver mutual funds usually invest in silver ETFs on behalf of investors. They provide silver exposure without requiring a demat account. So anyone can invest through a regular mutual fund platform?
Precisely. Investors can start with small amounts and even use SIPs. This makes silver mutual funds particularly suitable for beginners. Is there any disadvantage? Nilkant, since the mutual fund invests through an ETF, investors indirectly bear both the mutual fund expenses and the ETF expenses. Therefore, costs may be slightly higher compared to investing directly through a silver ETF.
Nund leaned back and summarized. So, physical silver offers direct ownership. Silver ETFs offer convenience and liquidity, and silver mutual funds offer simplicity for investors who do not have a demat account. Exactly. There is no universally best option. The right choice depends on the investor's objectives, investment amount, convenience, and preference for holding physical assets versus financial instruments. If you had to give one final piece of advice, what would it be? Nund smiled. Remember, Nund, the goal is not merely to buy silver. The goal is to choose the investment vehicle that fits your overall financial plan. A good investment is not just about what you buy, it is also about how you buy it. Nilkant concluded, as per my understanding of this market and the scenarios we are in, it is in the near future that gold will again become the reserve currency, and all the currencies or set of currencies will be backed by gold. Before becoming the reserve currency, there would be upheaval of social power. The U.S. will lose its dominance, and there would be a war-like situation, which gives the best opportunity to accumulate gold, and gold will multiply itself in a very short period of time, and then there would be normal return. As they left the cafe and walked home beneath the evening sky, Nand reflected on the lesson. He realized that successful investing was not about chasing the latest trend. It was about building a strong and balanced financial foundation. And among the many tools available to investors, gold and silver remained timeless assets that could help safeguard wealth across generations.